On the podcast today. How are you doing?
Good, thank you. How are you?
Very good as well here. Very good as well, Paul. And we are doing a little bit of an experiment today. We are live as we speak right now, live on Twitter, live on YouTube, Facebook, LinkedIn, and all the other social media platforms in order to analyze the DraftKings Q4 2021 report that was just released here a couple of hours ago. And before we jump in, I guess, to the first couple of questions here, Paul, I just want to read out the highlights of this report, if you want to call it that. Revenue 2021 for DraftKings, $1.3 billion. They made a net loss of $1.5 billion with an EBITDA of minus $676 million. Adding to that as well, if you want to dig into it deeper, marketing costs, that is always a reoccurring question with DraftKings, came in at $981 million, which is nearly 75% of the total revenue of the company. And also important to discuss, which I think will be a bit of a talking point today, is the 2022 guidance here to look forward with DraftKings. DraftKings talked about an expected EBITDA result of minus $825 million to $925 million EBITDA, with expected revenue coming in at 1.85 billion to 2 billion. So a significant kind of uptick in both revenue, but also as an expected EBITDA loss here. So it's always an interesting company to talk about here, Paul. And I want to kind of ask you as a starting point here, Paul, like what's your overall analysis of the report that came in today? The market so far have reacted with very negative sentiment, minus 16% on the marketing at opening. But what's your analysis here, Paul, first of all?
Well, there wasn't too much that was unexpected in that we know roughly where DraftKings is tracking from a market share perspective because the data gets published monthly by nearly every state. We know, broadly speaking, what the size of the market is for the same reasons. So with a few adjustments, you kind of know where things are going. We know that 2022 has started well with a huge Super Bowl and particularly New York being an enormous new market in revenue terms for the sector, and DraftKings performing reasonably well within it. So we also know that DraftKings spends a lot of money, and this report demonstrated that. So I guess the two questions are purely in the context of the report. Does losing roughly $900 million in EBITDA terms this year easily get you to profitability with that kind of revenue growth? Is it just another 50% and we're okay? Or is it just digging a bigger hole? And I suppose there hasn't yet been sufficient operational gearing evidence to persuade people that that is the case. So anyone who has a short on the company because they're persuaded that there's a structural cash flow problem hasn't seen anything yet to change their minds. I mean, in our view, it's reasonably simple that you need big states with relatively low levels of taxation and relatively easy access. And you need returns on all of that product and technology spend to start making DraftKings a clearer market leader rather than just a comfortable top three. Because the issue isn't so much the marketing spend, the issue is all the other costs that sit around the marketing spend.
Right. And Jason Robbins talked about in the report as well that he expects the company to be EBITDA positive by Q4 2023. In your estimation, how realistic is this target, considering that the EBITDA losses keep growing for every new market that opens, seemingly?
So I think there are two big questions. There are lots and lots of little questions, but there are two big questions. Big question one, does that require California to legalize commercially? Because then you've got a big 40 million person market, which is going to create some real operational leverage if it is legalized in a way that suits the operators who are pushing for and have crafted appropriate legislative frameworks for what they want to do.
Oh, it seems like we lost Paul there for a second, but he's coming back in. There we go. All right, we'll wait a little bit here for Paul turning back into the chat again. This is the, there we go. Paul, we have you back here. This is the beauty of doing things live. You never know what's going to happen here. But you mentioned California, you mentioned here.
Yes, and you could possibly, point to Florida if something happens with the court case with Seminoles, and then there's a sudden shift to go more commercial. We'll see. Those are big questions, though, with the company having very few levers of control over them. The second question is, do the customers who have been acquired at great cost now continue to gamble with DraftKings at roughly the same rate into this year and into next year, in order that you're building layers of value without attrition? And if those things come through, then yes, it is an entirely rational expectation. But if one of them doesn't come true, it is more challenging, we would think. And if neither of them comes true, then it's extremely challenging, we'd suggest.
Yeah, it's interesting. And I guess as well, looking forward until Q4 2023, it's a long way to go. And obviously the company is losing a significant amount of cash at the moment. They do have more than in excess of 2 billion euro net cash. But as we said, in 2021, they lost 1.5 billion. The market capitalization have come down for DraftKings. I think in this very moment, we are looking at a market cap of 7.55 billion USD market cap. And so I guess the question is, if they keep leading this amount of money and the expected result of 2022 is an even greater loss, will they be able to take that cash burn for that amount of time? Like, how will they continue to raise money in order to cover these losses?
Well, I think that's also, I think, the track when a company and a market both feel very, very confident about future growth. You can raise money on a very high multiple, which pays for itself. And that was, something that we commented on when they did the fundraisers. At the value that they were doing it, they were basically using their market cap. They were weaponizing their market cap in the industry, which was potentially super effective. But it's only effective while the stock market, or lenders, but I don't think that's going to happen, while the stock market is happy to give the company money. And I think an awful lot has changed in the last few months that frankly has nothing to do with US sports betting and iGaming, and a lot to do with broader sentiment that means that investors are unlikely to, as it were, chase their losses.
Right. And I mean, continuing on that path as well, the acquisition of Entain here recently was obviously not successful for DraftKings, and since that failure to try to acquire Entain, the market cap has come down significantly. And I assume that this also makes it more difficult to engage in M&A activity for DraftKings as we move forward here, as well as you point out here, they can't really weaponize the market cap any longer to do this kind of like all stock deals like they did with Golden Nugget recently as well, right?
I think it is much more difficult to do boss M&A, where they turn up and they're like, we're DraftKings, we're rearranging the world as we want it to be, and this is how it is. But I think perversely, it probably makes it easier to do different sorts of M&A.
Yeah, absolutely. And jumping over to something different here, Paul, which is the Hindenburg report caused obviously a lot of turbulence with DraftKings when it was released last year. And what the report was zoning in on was the fact that SB Tech, which was merged into DraftKings through the SPAC earlier in 2020, I believe. It highlighted the fact that SB Tech was deriving a large amount of the revenue from unregulated markets, essentially. Still, SB Tech is deriving 50% of the revenue from unregulated revenue. Do you think that this also plays into the part of the negative sentiment overall for DraftKings? Is this still an issue, do you think, from US-based investors, or is this past DraftKings at this stage?
I don't think it is. That's not to say that it potentially never will be, but I don't think it is. And it's not dissimilar to the Evolution situation. I think that the first thing that we would point out is that unregulated is a very dangerous word, and it's unfortunate that the industry has latched onto it as a word that it uses as a shorthand, because for a not domestically regulated is a really sort of boring way of describing something, but that's what we're talking about rather than unregulated. There's a point of supply, point of regulation, which has been gone through legal diligence and regulatory and licensing diligence by the very nature of the fact that the company has changed hands and the company has gone through regulatory approvals. So does that mean, therefore, that there is literally nothing to see here? Of course, there's always more risk in point of supply regulation when it coincides with domestic regulation. But equally, I think that this is one of those things where a little bit of knowledge can be very dangerous. And to land blows like that, you've got to be sure of malfeasance, not pointing fingers in a broad direction. So I think there are much bigger issues that the market is now looking at than that.
Yeah, fair enough. And as we now look forward into 2022, Paul, so Jason Robbins also talked about how if it wasn't for new market entries in 2022 onwards, he would expect DraftKings to be EBITDA positive by the end of 2022 already. But because of the new entries into new markets, that EBITDA positive result is being pushed by a year, essentially. And you would expect that now looking into Q1, where obviously New York went live, which is an expensive state to enter, and question marks around profitability in that state even long term. What's your expectations now as we look into Q1 and onwards for DraftKings? Again, they enter New York. There has been the recent Super Bowl, which obviously should generate a healthy amount of profits. It seems to be a quite pivotal quarter that is coming up here for DraftKings now. Like, what's your expectations now as we look forward?
Well, I think it somewhat reveals some of the structural limitations of US sports that we talk about quite a lot. They are enormously seasonal, more so than the sort of soccer, tennis, global basketball, horse racing that is the standard pillars of other markets. And they're far more skewed to the very high profile marquee tier 1 events than any of those other sports, which is a problem, because when you have a very high profile event, which is going to be a market share defining event, you have every excuse in the world to throw loads of marketing money and offers at it. Now, in a normal environment, in a European or nearly anywhere else environment, you can usually monetize those customers they'll bet on other stuff as well. But with the level of seasonality and concentration of US sports and the unwillingness of US bettors to engage outside of that concentration, there's a problem with the lack of other stuff. It doesn't exist quite so much in a gaming environment. And that's why gaming is materially bigger than betting on online overall in the US, even though you've got 19 states to 6. So therein lies the problem. So if operators work out how to engage their customers with longer tail products, and or have the ability to cross-sell gaming in a critical mass of markets, then you'll be able to see the big spikes in activity and marketing starting to add longer term value. But our concern is until that happens, then you get a big spike in activity, which is matched with a massive spike in marketing. The two cancel each other out, and then everybody goes home.
Yeah, fair enough. And I guess that's connected a little bit to the question here, as you mentioned, in regards to online casino specifically. The numbers from New Jersey just came out in the month of January, and they detail the fact that online casino play contributes something like about 2.5 times more revenue to the online activity totals in comparison to sports betting. And so do you think, as we look forward now into the future, is a company like DraftKings at the mercy of states legalizing online casinos specifically in order to be EBITDA positive in the long run, considering how much more profitable that vertical is in comparison to sports betting?
Well, you've got the Golden Nugget acquisition that we said at the time was one of the most elegant and obvious and sensible acquisitions that could be made. Literally nothing bad to be said of it, which is rare. We normally slate acquisitions, but not that one, for almost exactly that reason. And I think that the question is what happens to the US better customer profile in the long term. I think in the short term, it is not too dramatic to say that there isn't really a viable business model for profitably extracting value from US online sports bettors. So the question then is, how can you turn that around? And gaming is the really easy way to do it that's available right now operationally, but it has its strategic constraints.
Yes.
And then the question is, given that you're not going to be able to have gaming everywhere, that's just not how US regulation is going to work.
Yeah.
How do you monetize those US sports bettors more effectively? So how do you get them interested in more gaming style products in terms of their availability? So interested in soccer maybe, or tennis, or basketball. They're the obvious ones.
Yeah.
Virtuals if you're allowed. But without something like that, we think it's very, very difficult, because nobody is going to, or if there's an advertising ban in a critical mass of US states, that'd help everybody out. But I doubt that's going to happen.
Fair enough. I guess, if we want to take the perspective and the lens here of the bull case of DraftKings, they talk sometimes about the fact that we shouldn't look at DraftKings as an organization and judge them for how they look today and how their profile, how their product portfolio look today. But we should rather look at DraftKings for their vision, which is to become kind of the Amazon of gaming, as Jason Robbins states it. And what he means by that is they want to expand into different verticals. Last year, they launched the NFT marketplace as an example of this. And they might launch other products in the future that are touching other verticals as well. And how we should view DraftKings today is that they are building up, they're building their brand in order to have a head start whenever they launch into new verticals. And they can then use the massive databases they have in order to become successful in other products, again, like the NFT marketplace, the Autograph that was launched last year. Do you think this investment thesis holds up, or it seems, again, like it's a very volatile strategy that is very unproven, let's say? We don't even know which verticals they will enter.
It's other technology-led, brand-led, innovative gambling companies have tried this before. I'm thinking mostly of Betfair when it IPO'd in, I think, 2010, and it was a dismal failure. Now, there were separate circumstances as to in that context. The problem here, I guess, is that we specialize in gambling, and I'm naturally cynical and I'm approaching middle age. So, I would say what I'm about to say, but the broad structural problem with gambling is that it is not really mass market, not as a real engagement. You can tip into mass market with sports betting on a small, discrete number of events. So Super Bowl, March Madness, Kentucky Derby, that sort of thing. But you're only touching those customers who form such a huge part of your database for a very small amount of time to provide a very narrow service. That's not the case with Amazon or Google, or even the immersive way in which more people use Meta's products. So it's much more difficult to turn a niche into other verticals than it is to start with something which has real, credible mass market position and then look for monetizable niches. So you start with the customers and then you look to monetize them. This is not where we are here.
Mm-hmm. Right. I mean, Paul, let's say that we live in a alternative universe here where all of a sudden the CEO position is open and they, you get the call from DraftKings and they ask you to now step up and take the CEO position of DraftKings, and kindly you accept here. Let's say, what would what would be your course of action here with DraftKings? Would you pull back on spending? Would you continue this aggressive spend and strategy? How would you steer the ship if it was you at the helm?
We really liked the Entain deal. In our view, the business needs cash. Sustainable, recurring
revenue
that is not driven by equity markets, which is an inherently flawed model by default.
Yep.
So that's what I'd be looking at, frankly. Where can we still generate positive cash flow in markets with less hype, less burn, less focus?
Mm-hmm. Right. Would you be looking at? It seems like the next frontier for the American operators is now looking at potentially South America, a geographical expansion outside of the US. Do you think DraftKings is ready for that, considering that they would be up against the European operators who are more mature in those markets?
Well, I think there isn't a Latin American market for a start. Even though you've got two broad blocks of language, right. It's considerably more fragmented and complicated than that. And one of the things that we've seen literally globally is the enormous value of localization. Anyone who is not a deeply local offer is essentially a niche offer, even if it's a big niche. So Bet365's amazing ability to do in-play better than anybody else is effectively a niche when you look at the full range of products. So how DraftKings becomes sufficiently localized in markets that are also regulating in a way which is available to make money rather than in a New York sort of way, becomes a big question, because it's not the case of peering at a global map and saying we're in the same time zone as these guys and they like, broadly speaking, the same things as we do, so off we go. At the moment as well, broadly speaking, they are small markets. I mean, one of the good things about specializing in US sports betting is you can't look really anywhere and say that it's a small market, because you're sitting in a small market. But it is, in strategic terms, and compared to what people are hoping for, LATAM is still a relatively small market. So when you factor in that it's small and then you have to localize on many, many, many levels, we think it's going to be a market that's generated by local heroes, which are then going to get consolidated, not somebody sweeping in and saying we're going to dominate this with marketing expenditure. Like there are
Right.
certain, like I say, there are certain products like poker, like in-play betting, where you can do that. But when you don't have a massive product leadership that you're going to use, then it's very difficult to see how that's going to work.
Right, and that is the strategy that Betsson Group is choosing. For example, as they are entering many markets in Latin America, they are acquiring their way into the market by acquiring smaller operators in order to have that localized approach through those local partners. Yes, that makes sense. Speaking about geographical distribution here, Paul, as well, we have the Canadian province of Ontario opening up in a couple of months. And DraftKings have communicated that they will, of course, enter this market as well. Now, the Canadian market has been a grey market previously, and it's been dominated again by the European operators who have built up that local expertise in the Canadian market, built up their databases and the liquidity in that market that they can obviously use as a head start. What's your expectations here for DraftKings in Ontario? Because it seems to be under a little bit of a different circumstances than when a US state opens up, which had previously not been touched by anyone else than the black market operators.
So we think there is a degree of opportunity. So again, we were surprised by how little money Sports Interaction made as a strong sports bet-led brand in Canada with local expertise. Conversely, a lot of companies make an awful lot of money in gaming in Canada. So the trouble there is that if you're sports-led, then you're aiming for a very small market that you need to grow. Now that's possible because the monopolies haven't been able to do any mass market heavy lifting until very recently because of the limits that they've had on singles betting. So we do expect the betting market to grow, but it's growing from a very small base where you've got a few operators who are already doing pretty well. So it's going to be some pretty tough arm wrestling unless you're introducing new products. And what Canadians have been really missing is a US style sportsbook. But even then, there's been plenty of those in the Caribbean that can leapfrog the US and serve as Canadians. So we don't buy that really either. So the real big money battleground, just like in the US, is going to be gaming. And there are obvious advantages that a betting-led operator has got in gaming because they've got that mass market reach that they can then monetize. But the gaming pie always divides more than a betting pie. Yeah.
I think it will be really interesting to see as some of the European-based operators have been struggling in North America, trying to enter the market. Now, when they have been kind of establishing themselves in Canada, previously being a grey market, now kind of coming head-to-head in a sense with DraftKings and the newer American operators to see how they measure up, products against products and marketing expertise and efficiency within the organization. It's kind of like the how would you compare it to the Olympics in the 80s when the US went up against the Soviet Union in hockey, and the Soviet Union was always expected to sweep the floor with the Americans. It happened most of the times as well because of the legacy and so on. But we'll see here what happens in Ontario. I'm really excited to see the numbers coming out of that market.
Agreed.
As we start running off here a little bit now, Paul, but I have two more questions for you. The first one being, DraftKings is obviously heavily shorted as a stock, with more than 13% of the stocks being shorted. Why do you think that is? Why do you think that the stock is shorted to that extent by short sellers?
So I think there's a few reasons, but they all sort of converge. It's a loss-making business with a finite capital base. So that means you've got a sort of catalytic endpoint where the company has to say, we're going to have to cut costs, and therefore that's potentially going to impact expectations, which will be fairly catastrophic. Certainly would have been at the valuation that the business was, or that in order to continue the ball rolling, we're going to have to raise more money, which is.
Yeah. See, we lost Paul there for a little bit again. Like I said, it's always exciting here when you. Oh, there we go, Paul. We're back online here again. Can you hear me? Can you see me? Yes.
Hi there.
I think so. Yes. Sorry about it. Okay, go on, Paul. Continue on the short seller explanation.
I can't hear you.
Oh, you can. Okay, go on.
Okay.
Yes. Let's see. Can you hear me, Paul? Can you hear me okay? No?
If you can hear me, nod, and I'll finish answering my question. Okay, sorry.
Yes.
So,
yes, there we go.
And therefore, you get a catalyst. You get as a short seller, you always need a catalyst because it's very, very scary. Otherwise, and I think there's also been a real bear market in a really profound way. We're in very uncertain economic times coming out of COVID policies. So if you want to say, okay, look at a stock that's probably benefited from COVID and therefore could hit the unwind. So it's digital, it's being benefited from people receiving money to stay at home. You've got all the economic uncertainty coming through. It's exposed to government regulation and tax, which is a problem for governments when they're floundering around looking for what to do next. And you've got this issue of a big cash burn rate and a cash pile that could only go down, wild as a cash burn rate. So you can sort of see why people could be negative about that.
Right. All right. Thank you so much, Paul, and thanks for coming on today in general, and for giving all the good explanations. And we will see you here next time again. Thank you for the analysis. I wish you a great weekend. Take care.
Thank you very much.